Welcome to the deep dive. If you are the learner, well, you're in the right place to get past the usual financial jargon and really dig into what a company is actually doing strategically.
And today we're looking at Laurus Labs. We're pulling apart their latest earnings Q2 and H1 for fiscal 26.
Exactly. We've got the transcripts, the press releases, and our goal isn't just to read the numbers, it's to connect the dots.
Because the numbers are, frankly, pretty staggering on the surface. You've got H1 revenues up 33%, EBITDA, that core profitability metric, jumping 132%. Huge numbers.
Huge. But the really interesting part, I think, is how this connects to their massive spending plans, their CapEx. That's the tension we want to explore.
It's a story of current success fueling future ambition. Very ambitious plans.
Okay, let's unpack this. So lay out the current picture first. How good were these recent results, say, for Q2 specifically?
Yeah, Q2 was very strong. Revenues came in at 1,653 crores. That's up 35% compared to the same quarter last year.
35%. Okay.
And the EBITDA figure for the quarter was 429 crores. Now, that's up an incredible 136% year over year.
Wow. That kind of jump in profitability, that suggests something more than just selling more stuff, right? It points towards maybe a better mix of products.
Absolutely. That's exactly what's happening. Their product mix has shifted, and you see it reflected in the margins. Gross margins are holding really steady, right around the 60% mark. Q2 was 59.9%.
Okay, nearly 60%. So where is that high margin contribution coming from? Which engine is really firing?
It's definitely a dual engine. You know, they have the generics and the CDMO side, but the star, certainly in terms of momentum and profitability, has to be the CDMO business, contract development and manufacturing.
Right, where they make ingredients or drugs for other pharma companies. How big is that piece now?
It's becoming very significant, especially the small molecule part of CDMO. In Q2, that segment alone brought in 471 crores,
Okay.
which is a 58% jump compared to last year.
58%. That's massive growth. What's behind that? Just one big order or something more sustainable?
It seems more sustainable. Management pointed to a strong mix, deliveries from mid to late stage development programs, you know, things getting closer to commercial launch, plus ongoing commercial sales. It's not just one hit.
That makes sense, feeding those higher margins.
Yeah.
But we shouldn't ignore the foundation, right? The generics division. Laurus is still a leader in antiretrovirals, the ARV drugs.
Definitely. That's the bedrock.
So how's that core business doing? Is it stable, growing, shrinking? What's the outlook there?
Well, the overall generics division actually grew 28% in Q2, reaching 11,135 crores. So still growing nicely.
28% is still very healthy growth.
It is, and specifically on the ARV side, management is guiding for stability. They expect the annual ARV business to be around 2,500 crores. Could be a couple hundred crores higher or lower, depending on, you know, tenders and bulk orders.
So predictable, a
Yeah.
solid base.
Exactly, a
Sure.
predictable revenue stream. And they've also done work internally, API rebalancing, getting rid of bottlenecks, particularly in ARVs. This helps them make sure they can actually deliver on their commitments to customers. They're strengthening that core.
Strengthening the core while planning this huge expansion. That brings us neatly to the CapEx story. Because if things are running this well, why take on so much investment risk right now?
Right.
Their plans are, well, monumental. Here's where it gets really interesting.
It really is. The biggest news on this front is the land. They've been allotted a huge parcel of land, 532 acres, by the Andhra Pradesh government down in Vizag.
532 acres. Just to put that in perspective, how big is that compared to what they have now?
It's massive. It more than doubles their existing footprint. It's clearly for a very large long-term vision. They're talking about a world-class pharmaceutical manufacturing complex.
Okay, world-class complex on 500 plus acres. That sounds expensive. What's the price tag and the timeline?
They've proposed investing $600 million US, so roughly 5,000 crores. And that's planned over the next 8 years. But here's the key point. Management made really clear.
Yeah.
That 5,000 crore plan for the Vizag mega complex, that's on top of their existing already significant CapEx plans.
So it's an additional layer of spending. What is the baseline spend then? What are they looking at for, say, this fiscal year, FY26?
For FY26 alone, they're expecting total CapEx to be close to 1,000 crores. So you add the Vizag project starting up on top of that, it shows a real appetite for investment.
1,000 crores this year, plus starting the 5,000 crore Vizag project. That's aggressive. Doesn't spending that much that fast put pressure on the financials, on near-term profitability?
It certainly can, and management acknowledges that. They were pretty open about their philosophy for these new areas, new technologies, especially the advanced stuff we'll get to.
Right.
You have to invest up front. You build the capacity first. The revenues come later. So yes, there's an accepted lag.
A lag period. So how do you, the listener, track that? How do you know when these huge investments start, pulling their weight? Is there a metric?
Yeah, the key one they highlighted is asset turnover. Basically, how efficiently you're using your expensive factories and equipment. Right now, because they're building ahead of the curve, their asset turnover is a bit low, around 0.9 times.
Okay, so less than 1, meaning assets aren't generating quite their value in sales yet.
Correct. It reflects that lag, that investment phase. But they expect it to get back to their normal historical average, which is about 1.1 times.
And when do they expect to hit that 1.1x mark again?
They've guided for the next 24 months. So over the next 2 years, as these new facilities come online and start producing, that asset turnover should climb back up. That's the time frame to watch for the payoff.
Got it. 2 years to get back to efficient operations on the new assets. That makes the strategy trackable. Okay, so where specifically is this near-term 1,000-crore CapEx going? What are the big strategic bets beyond just land?
Well, there are a couple of really interesting targeted investments in advanced therapies. First one is in ADCs, antibody-drug conjugates. Big area in cancer treatment.
Right, ADCs. What did they do there?
They made a strategic investment, about $2 million, into a company called Arvig Therapeutics.
Arvik. Why them? What does that $2 million buy, Laurus?
It buys them access to novel ADC technology and, crucially, the related R&D know-how. Laurus already had pieces of the puzzle, like expertise in payloads, the drug part, and the linkers connecting them. This Arvik investment brings in the other essential bits: the conjugation process itself, purification, and the fill finish, basically bottling the final product.
So it lets them offer the whole package, an integrated ADC service from start to finish.
Exactly. It accelerates their ability to be a one-stop shop in a really hot therapeutic area. Speed and integration.
Makes sense.
Yeah.
Okay, ADCs is one bet. What's the other big technology push? You mentioned large molecules earlier. That usually means fermentation, right?
That's right. Their bio division, which handles large molecules CDMO, it's already showing some recovery revenues. We're up 62% quarter on quarter in Q2. But the big play is the new facility.
The one in Vizag.
Also in Vizag, yes. Construction is underway for a commercial-scale fermentation facility. And it's on track.
And what kind of scale are we talking about? Is it significant?
Oh, it's very significant. Phase 1 capacity is planned at 400 kiloliters. That's a huge volume.
400 KL. Wow. When does that come online?
Expected to be ready by the end of 2026. And it's worth remembering, they actually shifted this project. It was initially planned for Mysore, but they moved it to Vizag.
Why the move?
Better infrastructure, better logistics, they said. It all ties into this theme of building for massive scale efficiently in Vizag.
Okay, so ADCs via Arvik, huge fermentation capacity in Vizag. Are they doing anything in cell and gene therapy too? That's another advanced area.
They are. They're building a separate facility for that in Hyderabad. It's a CGMP facility focused on gene therapies and, interestingly, also antibody-drug conjugates again.
Also ADC, so doubling down there.
Seems like it, covering different aspects maybe. That Hyderabad facility is also targeted for completion by the end of 2026.
Oh.
But management was careful to manage expectations here. They're building the capability in cell and gene therapy, but they don't expect significant revenues from it for maybe 3 to 5 years.
Right, that's a longer game.
A much longer game, the exception being their existing investment in immuno-ACT, which is already in that space.
Okay, so summing up, strong current performance, huge land acquisition for future scale, targeted bets on ADCs, massive fermentation, and early steps in cell and gene. It's a lot. Is the company, operationally healthy enough to handle all this level of spending?
That's the crucial question, isn't it? And the indicators look pretty solid. First off, quality and compliance seem impeccable.
Oh, so?
In the first half of this fiscal year alone, they passed 65 different quality audits. These weren't internal checks. These were by customers and major regulators, US FDA, WHO, European agencies.
65. Any major issues flagged?
0 critical findings reported. In this business, especially CDMO where trust is paramount, that clean record is a major asset. It tells customers they're reliable.
Definitely builds confidence. Okay, quality looks good. What about the balance sheet? All this spending must mean taking on debt, surely.
You'd think so, but they've actually managed their debt extremely well, thanks to that strong cash flow from operations we talked about earlier.
Right, the high EBITDA growth.
Exactly. Their net debt leverage, that's net debt divided by EBITDA, has come down dramatically. It's now at 1.3 times EBITDA.
1.3x. What was it before?
Just compare it to H1 of last year, FY25, when it was 3.4 times.
Wow, okay, so they've significantly paid down debt even while growing.
Precisely. They've deleveraged substantially, which means they now have the financial breathing room, the flexibility to take on this next big wave of strategic investment without putting themselves under massive financial strain.
That context is vital. It explains how they can afford to be so bold. So management must be feeling pretty confident then. What was their overall tone, their outlook?
Overwhelmingly positive, I'd say. They used phrases like growth prospects look very bright, particularly for both small and large molecule CDMO.
And that brightness justifies building ahead of demand.
That's their rationale. They see the demand coming, so they're building the capacity now to capture it. And maybe as a small signal of that confidence, they also declared an interim dividend. 0.80 per share.
That's right. Paying dividends usually signals belief in sustained future profits. Okay. Let's try and wrap this up. So what does this all mean? If you're the learner, what's the key narrative to take away from this deep dive?
I think the narrative is this. Laurus Labs is firing on all cylinders right now, especially in the high-value CDMO space. That's generating strong profits and cash.
Okay, step 1, current success.
Step 2. They're immediately reinvesting that success very aggressively into the future, big time, primarily through securing land from Massascale and Vizag.
Right, the 532 acres.
And making very specific strategic bets on next-generation technologies like ADCs and large-scale biomanufacturing through fermentation.
So current strength funding, future dominance, essentially.
Yeah, that's the plan. It's definitely a high-risk, high-reward strategy, no doubt about it. Management is betting that this shift towards complex, high-margin CDMO work will keep pushing their overall operating margins up, maybe even past previous peaks.
And the risk is that lag period, the time between spending the money and the assets actually producing efficiently.
Exactly. That temporary hit to efficiency, measured by that asset turnover metric, is the calculated risk they're taking to enter these advanced markets with significant scale right from the start.
Okay, which brings us to our final provocative thought for you, the learner. We know the company is comfortable spending around 1,000 crores a year on CapEx, maybe more now with Vizag starting. We know they expect asset turnover to recover to 1.1x in 2 years as justification. So the question is, beyond just tracking that overall asset turnover number, what specific signs should you look for over the next, say, 2 years to really confirm that that huge new 400 kiloliter fermentation facility in Vizag is ramping up successfully? How do you gauge if that specific bet is paying off on schedule?
That's a great question. I'd say you need to watch the specific revenue contribution from the large molecule CDMO segment in their future quarterly results. Is that line item growing substantially once the facility is commissioned? That's the direct proof point for that investment.
Perfect. Watch the large molecule CDMO revenue line specifically, a fantastic focus area.
Yeah.
That brings our deep dive into the strategic thinking at Laurus Labs to a close. Thank you for joining us. As always, we encourage you to check out the source materials yourself to continue exploring.